Seriously, what the fuck is up with you, Doomer Bears on X? Especially that little snowflake Michael Gade. He's been so wrong with every prediction so far, and has been consistently underperforming SPY in his rinky-dink ETFF. His strategy is to just measure the ratio between gold and lumber over a random period of weeks that somehow tells you that a shiny rock versus a piece of wood may decide the direction of the Russell versus bonds. Yep. Rocks versus wood. It's like rock, paper, scissors, but for investing. Someone give that little bitch a ladder so he has a chance of reaching the right conclusion once in a while.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and another green day. What we saw was an everything rally led by financials. The big banks after their earnings reports really put on a show. JPMorgan, Bank of America, Citigroup, Wells Fargo, and even credit services, non-bank financial services stocks did well. PayPal up 2%, Capital One Financial 3%, American Express up 2% on the day. Visa and MasterCard lagged behind the overall financial index, but a very strong day in financials. They led the pack. But what didn't participate today were the big three, Nvidia, Microsoft, and Apple. Nvidia and Microsoft were virtually flat on the day, Apple slightly down. Other than that, it was a very strong day across the board. Google and Meta gained. Most of semiconductors, excluding AVGO and Nvidia, gained. Software was very upbeat and just an overall green day and everything rally. And let's actually look at some of the biggest gainers and losers today. Shares of Tesla sank 8% Friday morning after Elon Musk revealed the long-awaited driverless robo-taxi on Thursday night, which left investors wanting more. Now, the Cybercab and the robo-taxis were actually really cool in my personal opinion, but there was no dates. And I think what the market was really looking for was an electric vehicle under 30,000. Elon didn't comment on that or a timeline as to when that may happen, a cheaper electric vehicle. And that's why Tesla was down 8%. That being said, I thought the overall event was pretty cool. On the flip side, shares of Uber was up 10%. Lyft, the rival company, was also up 8% as investors appeared unimpressed with Tesla's robo-taxi unveiling. They didn't see any near-term competition. That has weighed on Uber stock in the last couple of weeks after the Tesla event and lack of details yesterday. They don't see robo-taxi as a significant competition driver in the next couple of years. Shares of Uber were up 10%. And looking at the market more broadly, every sector gained here except for the XLY, which is the discretionary, on the back of Tesla falling 8%. Other than that, broad-based gains across the board. Technology underperformed on the back of lackluster performance from Apple, Microsoft, and Nvidia, only up 0.17% on the day. The SPY was up 0.6%. Tech did weigh on the overall index. The majority of sectors outperformed the SPY. We really did see an everything rally today, a broad-based rally, with financials being the best performing sector, up 1.193% on the day. And guys, financials are one of the top performing sectors year to date, and I think this is sort of going to carry them into the fourth quarter earnings season. So we're probably going to see a very, very solid fourth quarter in terms of gains from these financial companies. Industrials also gained, up 1.79%. Real estate was up 1.02%. A very strong day across the board, but not just large caps, mid caps, small caps, particularly small caps. In fact, small caps sort of got left out of the conversation today because of bank earnings and the Tesla event, but they were the outperformers. Value core and growth really did outperform. Mid-cap core, mid-cap value performed too, but guys, it was just a green day with smalls outperforming mids outperforming large, and really just the market getting back into low beta, higher quality. And that's because we sort of just brushed off the CPI news yesterday. Yes, we did get a warmer CPI print, but that was on the back of stronger economic macro fundamentals. We also then got a cooler PPI. PPI and core PPI came in at 0% and 1%. The market's expectation was 0.1% and 0.2%. So we got a slightly warmer than expected CPI that was backed up by strong macro fundamentals and a cooler PPI. Everything screams Goldilocks. But what also helped the rally in smalls today was the big financial banks. A huge part of the Russell 2000 is stuff like regional banks. And when we have strong bank earnings, the Russell is going to perform perform because 40% of the Russell is financials. Guys, and we had a very, very strong day of earnings. All of the big banks and all of the financial companies that reported today beat on earnings. We saw massive upside earnings surprises, and there was a lot of commentary around NII and the future outlook. The only company here that missed on revenue was Wells Fargo. They missed the revenue forecast, printing 20.3 billion. The forecast was 20.4. But diving into some of the bigger names, JPMorgan rose 5% today. Very strong move after reporting a double beat. Earnings of 437 against a $4 estimate. Revenue was 43.3 billion versus the street's estimate of 41.6. The market also liked what Jamie Dimon had to say. Net interest income surprised to the upside NII, and JPMorgan also raised their full year guidance. BlackRock was also up 3.5% after posting a double beat too. They also recorded record assets under management of 11.5 trillion, as well as record Q3 inflows. We are starting to see that money on the sidelines come in, and all of this momentum, guys, meant that market breadth recovered after yesterday's hiccup. Shorter term averages did come under pressure. The 5-day and 20-day did fall below the 50% mark. However, we saw a robust recovery on very strong market breadth. In the S&P 500 today, there were 434 gainers, 69 losers, literally just an everything rally. Very, very strong market breadth, and now short-term averages are looking very good. Longer-term averages improved as well, and the ultimate long-term average, the 200 moving day average, very, very strong, very robust. And all of the price action we saw today, as well as the technicals and fundamentals, really set us up for what is a fairly light week of data next week. And I think the path of least resistance next week is probably going to be higher. I don't think there's anything that's going to derail us unless we get absolutely horrendous earnings. And I think the big banks set up earnings season really well for next week. And when we take a step back and look at the bigger picture, the last 5 days of trade or the last week of trade, we see the S&P 500 up 1.15%. The biggest sectors in the market really performed and helped to lift the S&P 500. Healthcare, financials, industrials, and technology were all up 1.5% and above, with the star performer technology up 2.5% today. The worst performing sector was actually utilities, down 2.5%, discretionary on the back of that Tesla event, as well as communication services. If you don't remember, Google fell a lot on Monday and Tuesday after there was talks of a breakup, and then energy, XLRA, and staples were flattened down in this region. So what we really saw was like defensive sectors and high impact news sectors underperformed this week, but cyclical sectors performed really well, and where there wasn't high news impact, which was sector specific, those stocks did really well. And that's why we actually had a fantastic week in the broad market, but it was broad-based gains. Now the Nasdaq 100 was the best performing sector, up 1.18% for this week. The SPY up 1.18%, and the market is still hanging on to broad-based gains because the Nasdaq 100 or the mega caps didn't outperform the S&P 500 by that much. The RTY actually outperformed the overall market since its lows here on Thursday, absolutely shooting up 2% in today's trade to finish the week off just shy of 1%. The RSP, the equal weight, up 0.74%, still a gain on the week. You take those gains when they come, but the worst performing index for this week. All in all, a bullish week, a strong week, and I think everything we saw today sets us up really well for next week. It's just going to depend how yields and the dollar react to all of these moving parts we got this week, next week. And in the context of everything we saw today, with small caps rallying, large caps rallying, mid caps participating too, we actually did see yields rise across the curve. The 2-year yield, 10-year yield, and 30-year yield were all up. The dollar gained as a result, and that probably did put a little bit of a cap on equities, particularly the larger cap segment. We also saw some very weird price action outside of what we would normally see. Yields rose, the dollar was relatively strong today, and gold and silver actually gained. Crude down. Looking at gold and silver, they were both up in excess of 1% today, so still a little bit of hedging activity there. The market really liking the precious metals trade, but looking at the S&P 500, all in all though, today really was just an everything rally. I mean, even just look at bonds. The AGG was flat. TLT was down today, but if you were in stocks, if you were in bonds, if you were in commodities, you really did well today. It was just a broad-based rally. And the S&P 500, looking at the weekly chart, look at this candle right here. Very, very strong. That's a new weekly closing high at 58.15. And we're not even at the core resistance just yet, guys. And this weekly chart looks strong. Higher lows, higher highs, new all-time highs. This is bullish. And look at this. Higher low, higher low, higher low. And until we actually go ahead and break this 5400 area, I remain constructively bullish on the weekly chart. We can pull back in the next couple of weeks to this level, find support above this area and go. That would be very, very constructive. Does get a bit concerning below the 5400 area, but there is a ton of distance for the bulls to cover, say 7% pullback. So we can pull back as much as 7%, guys, and things would look largely constructive for the overall market. Do I see that happening? Probably not. Not with the start we got to earnings season with the big banks. I think we're just going to grind higher highs, higher lows next week. We don't have a lot of high impact data, just retail sales. And I think the market's already priced in a skewed effect from the hurricanes and disasters. So even if we do get a weak retail sales number, I don't think it's going to upend the market. Diving into the daily chart for the S&P 500, we see very, very strong chart. Year to date, this looks very, very strong. And it does look like we're actually broken out of this island base that we formed right here. Sort of broke out on Wednesday, and we're continuing higher to the 5850 area. Still a tiny bit of upside, so maybe we go and get that, Tuesday or Wednesday into that time frame next week. But a little bit of upside. We are in positive gamma, and you want to buy dips, sell rips. But this does look like a technical breakout in the month of October, which is not necessarily a bad thing. The macro is good. The fundamentals are sound. Everything looks really, really robust right now. Just equities look very, very strong. And it's not just the S&P 500. It's the mega caps too. I mean, yes, higher highs, higher lows. We are sort of forming a base at this equal high. But the second we break out, right, it's new all-time highs for the Nasdaq 100. We also saw the gamma flip zone move up ever so slightly for the Nasdaq 100. That's very, very constructive. So a little bit of bullish bets coming back into the market there. Looking at the RTY, we also saw the gamma flip move up a mere 5 points, but this does look like a higher low right now because we did go ahead and break some of these key levels after today's huge 2% move on the RTY. And guys, look, higher low, higher low. This could be a higher low if we see a move to the upside. I've been saying that all week. I want to see an impulse move in the RTY. Now we just have to go take out the 2275 area, and then that's pretty much new 52-week highs for the Russell. Large caps look constructive, small caps look constructive. Looking at the RSP, mid caps, the broader market, very, very strong. Look at that candle, very similar to the S&P 500. It's like an island right here. We're breaking out, and I think next stop 180, 181, 182 this week, and 200 into 2025. I'm very bullish on the RSP. I think it's going to do very well in the next 12 months. But all in all, equities are richly valued, guys. If you guys do want to find value in the market, I would look at stuff like SHSQ. This is a small cap quality index. It actually outperformed the Russell today by 1 basis point. That's what you want to see. You want to outperform your benchmark. And I think looking at small cap quality, you're still getting this at 14x on a PE ratio, 14 times. And they're growing earnings at like 16%. Absolutely crazy. I think we're about to see a huge breakout in these names. If you want to stay in the larger cap space, you can look at stuff like Moat. This trades on the ASX as well as the New York Stock Exchange. It's pretty much like the RSP, except they look at companies with wide moats and then put them in the index based on distance from fair value. So you're essentially getting wide moat stocks trading below their intrinsic value. And this ETF right here has actually outperformed the S&P 500 in the last 10 years. Very, very solid performance. This is new all-time highs for the moat index. And if you're on the ASX, this ticker actually pays an 8% dividend. Very, very crazy. So, but that has to do with currency conversion. So those are two places to look at. Another small cap ETF I do like is the small cap cash cows. It was up 1.68% today. Very strong. So I do like small cap quality if you're looking at the smaller names because they have exceptional balance sheets and their earnings are growing in line with the S&P 500. In the large caps, I do like the RSP. I like Moat. promote individual names. Guys, buy Google on this weakness. I think Google's going back to all-time highs once all of this just gets brushed off under the rug. Great value right here, the cheapest Mag 7 stock. I still do like PayPal, a little bit rich. The valuation is getting a little bit rich. However, I do like PayPal, and I do think we're going to go to $100 in the next 12 to 18 months. Substantial upside. But for those of us that are long sub 60, well done. I like Paycom Holdings. This is a very, very solid stock, deeply undervalued. I think fair value for this stock is $204, by the way. It trades at 162, but there's just a lot of competitive pressures and revenue cannibalization that we need to get through over the next 12 months to really see this soar back to all-time highs. I do like this name. And for those of you that are in Australia, I really like PEXA Group. This is quite virtually probably a bigger monopoly than ASML in terms of e-conveyancing and real estate transactions. They finally started international expansion. So if you're looking for an undervalued mid-cap play on the ASX, I really like PEXA Group, ticker PXA. So that's where I would look to for ETF and single stock names on the New York Stock Exchange as well as the ASX, guys. But you know the name of the game. We are in positive gamma across all of the major indices, and that means buy dips, sell rips, aim to the upside core resistance targets, and don't fight the trend, guys. We are moving higher. The path of least resistance is up. Diving into sentiment, this is Goldman Sachs sentiment indicator. They pretty much track institutional, retail, and foreign investor positioning versus the last 12 months. And essentially what this number tells us right here is that compared to last year this time, institutional, foreign, and retail investors are positioned at about the same level as they were, slightly more stretched than they were, ever so slightly, but the 0.3 level is virtually inconsequential. It would really only be considered significant once it gets above the 1 line right here, which is 1 standard deviation above last year's positioning. And as you can see, we have seen a significant decrease in overall positioning. In other words, leading up into where we are right now, we have seen some significant selling, but since then we have found a bottom, and this is telling us that there has been some buy-side action in the last couple of weeks. And the thing is, retail, institutional, and foreign investors are buying the dip because it has been a fantastic year. Year to date, the S&P 500 is up 20.6%. The 3 best performing sectors, comm services, tech utilities, and financials, we're actually going to include 4. All 4 of these are above the 20% in return, with comm services and tech both at 29%. Very, very crazy. And you know it's been a bullish year when the best performing sector is up 8.5% in the month of October. Very, very bullish. This is slightly below the S&P 500 average. Every single sector doing double-digit gains for the year to date. And this is a bull market. And the truth of the matter is this rally is supported by the fundamentals. If we actually look at overall earnings growth, we see significant earnings growth, particularly in the tech stocks. Look at the Magnificent 7, Q1, Q2, Q3, Q4, all above 20% earnings growth. The first quarter, 50% earnings growth year over year in that quarter. However, S&P 500 x the Mag 7 is yet to see any significant gains in earnings. While we saw negative 2% in the first quarter, we did see a 6% growth in the second quarter, and we are entering into the third quarter earnings season. We are looking at flat returns with the majority of earnings growth still coming from the Magnificent 7. That is set to change in the fourth quarter, where we do see a broadening out of 13% earnings growth x Mag 7 and 21% for the Mag 7. So you do want to be exposed to technology, guys, to the Mag 7 because they are producing significant earnings growth, but you also want to be exposed to the broader market because earnings are set to broaden out, as this data suggests right here. And for those of you that have been living under a rock, the reason why we've seen the Magnificent 7 outperform the market is because, yes, they've grown their earnings significantly more than the broader market, but they've also seen margins expand since the fourth quarter 2022. Margins pretty much went from 15% at the start of 2023 to 23.5%. We've seen margin expansion, whereas the broader market has really just seen their margins go flat for the last 5 years, sitting at 8.5%. And when you have growing earnings earnings, margins are expanding, stocks are going to outperform, and that's why the Magnificent Seven has outperformed in 2023, 2024, and probably will continue to outperform, but not without some volatility, because the broader market has really come back in very, very strong fashion, especially in the last couple of months. You can see at their peak in July, the Mag 7 contributed 12% of the 19% rally in the S&P 500, driving 64% of the overall return. There was a lot of worry that when they fizzled out, the market would be in big trouble, but the truth is that is simply not the case, because we've actually seen the S&P 500 continue to rally despite the stalling Mag 7. And just imagine what happens to the market when the Mag 7 becomes a tailwind in the fourth quarter. We are going to see a blistering rally, and that is why I do think we are going to see more upside, and I have a price target of 6,000 by year end in the S&P 500. Now, the gains on the Magnificent Seven did stall at around the July period 2024, and since the peak in the Magnificent Seven, the S&P 500 has actually gained 3.72%. Almost 0% of that gain came from tech. Every sector contributed to that gain besides technology, the biggest contributors being financials, industrials, and healthcare, telling us that the market rally is broadening, and this is very, very healthy. And diving into the macro, this is the Dallas Fed's weekly economic index, and you can see Q4 GDP growth tracking at about 3%. This area right there, weekly economic index tracking at 2.1%. Very robust growth. You like to see that, especially with rate cuts on the horizon. Something else that's very interesting, if you actually look at consumer spending, recent spending growth has been robust, but discretionary categories has been outpacing non-discretionary categories. You can see that discretionary far outpaced semi-discretionary right here, as well as non-discretionary. And in 2024, non-discretionary and semi-discretionary is roughly the same, slightly higher year in semi-discretionary, but discretionary spending significantly lower than the 2019 average. And I think as we get rate cuts, as the cost of capital becomes cheaper, and as certain parts of the economy open up, I think we're going to see discretionary spending also heading into this Christmas period tick up in a very big way. If you see that, you know the economy's roaring and we're not in a recession. That being said, discretionary and semi-discretionary still outpacing non-discretionary, very healthy, very robust. However, there are a couple of risks that we do need to be aware of. In states strongly impacted by Hurricane Helene, total card spending dropped sharply at the end of the month. As you can see, Florida, Georgia, Texas, and all of these states versus the overall US actually saw credit card spending tick down against the overall US spending, which ticked up and has remained largely robust in the last 3 months. So this is going to weigh on stuff like retail sales, durable goods, and it might actually also impact jobs as well as inflation. We'll see what the flow-on effects from these are. However, we do have to be aware of that, and the market will probably start to price that in, especially if these natural disasters go on for a prolonged period of time, especially into this fourth quarter. And lastly, guys, looking at earnings next week, this is the big names reporting listed in size of market cap. We have United Health, Procter & Gamble, Johnson & Johnson, Netflix, Bank of America, Abbott Laboratories, American Express, Blackstone, Morgan Stanley, Intuitive Surgical, Goldman Sachs, Schwab. So still a heavy week in the financial space, but we also have some big healthcare and staple names like Johnson & Johnson, United Health, PG, Abbott Laboratories, as well as Netflix to get the tech sector going. These are the EPS estimates the market is expecting. This is the revenue forecast. You guys can go ahead and have a look at all of these. But next week, the thick of earnings season starts, and then week after next, we have the major tech names reporting earnings. But we got through this week. Fantastic earnings so far, especially in the major banks, JPMorgan, BlackRock, and hopefully we can build on this momentum and have a stellar earnings season just like we did in the second quarter. Looking at data next week, we also have a fairly decent week of data. Now, we don't have much on Tuesday or Wednesday. We just have the New York Empire State Manufacturing Index, as well as import-export prices. Then it really kicks off on Thursday. We have retail sales, initial jobless claims, And then on Friday, the big data prints are the building permits as well as the housing starts data. So definitely not as big as this week or last week. However, still a huge week of data on the back of a big week of earnings as well. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.